happened, Mr. Nageswaran. Many thanks for joining us here on CNBC-TV18 and congratulations on your second economic survey. There's a lot to unpack in the survey, but let's address the growth number there, because while you have called it prudent, many on the street believe it is conservative. You've also articulated the reasons why you've kept the number between 6.5% to 7%. You believe that on account of the patchy monsoons, rising financial global market risks, as well as geopolitical uncertainty, all of this is going to weigh on growth. But is that the reason, or is there an overall recalibration as far as our growth aspiration is concerned?
Thank you, Shadin. First of all, there is no need to read much more than what I said in the presentation, which is that we, in February, when we wrote the Indian economy a review, we were much more confident of the 7% number for FY25, because at the time the monsoon was still not on, and geopolitical conflicts, we didn't think that they would continue or even escalate further. And financial markets have continued with their rise, and naturally, therefore, now what we are seeing is maybe some signs of rising global political uncertainties, and financial markets beginning to react as well to that, and the monsoon being patchy, as you mentioned. So this is just our recognition of the near-term factors, incremental factors at the margin that have become somewhat unfavorable. But we believe that if we persist with the kind of reforms that we have illustrated in the survey at all levels of government, and with the private sector pitches in with its capital formation and employment generation, etc., achieving a sustained 7% growth rate in the coming years is possible.
You know, let's address that sustained 7% plus growth rate aspiration that you talked about, because you also said that the glue to sustaining growth lies in the nuts and bolts of deregulation, which you've also called the low-hanging fruit, Chief Economic Advisor. And you said it requires the grunt work to grow from the $10,000 per capita to the to $2,500 per capita to the $10,000 per capita. It will require an entirely different playbook. But how confident do you feel that we do have the nuts and bolts in place at this point in time, or it's work in progress to be able to make that big leap from 2,500 to 10,000? Have we changed the playbook enough?
No, I think that's a good question. But, while it may not be possible for us to answer whether we have what it takes, that is where we have to look at where we were and where we have come. And I presented the information about the fact that our per capita income in dollar terms was 348. Barely about 30 years ago, and we are at 2,500. That's a growth rate of about close to 7 times. So we have done that. And therefore, there is no reason to be pessimistic about the fact that we could rise to the occasion in terms of, and many states have done several reforms in areas where other states may have lagged. So I think the important thing is to induce a sense of competition among states. That is where the finance minister and the honorable prime minister repeatedly talk about the importance of tapping into both competitive and cooperative federalism. Those have to be put into action. Then it is possible that this deregulation agenda can kick off in all the states.
And that is a separate issue for another debate. But let me address the issue of private sector investment and private capex. And, while you do point out in the survey that signs are encouraging of private investment picking up, the demand from industry continues to be that the government will need to do the heavy lifting when it comes to capex. In fact, industry is demanding that the government improve on or better on the number that was presented in the interim budget. Do you believe that that is a legitimate ask, that case is warranted? Industries ask that the government continues to do the heavy lifting when it comes to capex.
The government has done the heavy lifting in 2 areas very, very substantially. One is with its own public investment, 2, getting the banking system balance sheet right and the banking system capitalized. And in fact, I would go to number 3, which is that the government cut the corporate taxes in September 2019. And the proof of the pudding is in the fact that I mentioned in the presentation as well, on a sample of over 30,000 companies, profit before tax in FY20 was 5.3 trillion or 5.3 lakh crore rupees. and FY23, it had risen to 20.6, which is almost 4 times. So the private sector has had an excellent run, which is good for them, and they have great balance sheets now. So now it is time for them to come good, or not for the sake of the economy, not for the sake of the government, but for their own sake. Because without employment generation, income growth, there will not be demand visibility, which is what they need as well. So that's why I said in the medium term, it's a win-win for them to follow through on the excellent profitability growth that we are seeing in the corporate sector.
You know, I know, CA, that you're calling for indicted self-interest on the part of the corporate sector. And you said that the corporate sector hasn't had it as good as it currently does. But you also point out in the survey yourself that hiring and compensation growth haven't kept pace. So what gives you the confidence that this enlightened self-interest will start to kick off and we will, in fact, see the kind of growth that you expect both on hiring, compensation, as well as private investment?
I think, Shireen, you are actually contradicting yourself. In the earlier question, you were asking me about my growth being conservative, and you are asking me why am I being optimistic about private sector's enlightened self-interest prevailing. So I am optimistic, as I said.
I'm only asking you on the back of what the survey itself says, that you know, while corporate profitability has quadrupled in the last 3 years, the same cannot be said as far as hiring trends or compensation is concerned.
They may have the reasons for reasons of COVID and the demand uncertainties coming from external shocks, but they have to understand that India is a large domestic economy and some of the demand generation is endogenous. I think we have to close here because, you know, we have a series of interviews coming, Shireen, with other people, so we have to come back.
May I request one final question, CA, and that has to do with jobs, because that is something that you spend a lot of your time talking about in the survey. You talk about the fact that India needs to generate 78.5 lakh jobs annually by 2036. Now, you know, again, I go back to the ask from industry: more PLI for labor-intensive sectors, more employment-linked incentives across sectors. Do you believe that that is a legitimate ask on the part of industry? And how do we get to this 8 million number that you spoke of in terms of jobs?
Look, in a large country, it's always possible for everybody to have asks, and to invoke the famous lines from some American presidents. Is always important to talk in terms of asks and gives as well, which is what the survey points out.
We look forward to speaking with you again tomorrow as the budget is presented, but appreciate you joining us this evening on CNBC-TV18. Many thanks for your time. That is the Chief Economic Advisor, Nageswaran, on CNBC-TV18. We are going to take a break and return with more. Don't go anywhere. We're back in a moment.